Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sturm Ruger Company Inc. Annual Report. Sturm Ruger Company Inc. offers a wide range of businesses and services under its Ruger name and trademark. The company's primary business segment is the design, manufacture, and sale of firearms, including single-shot rifles, autoloading pistols, bolt-action rifles, modern sporting rifles, and revolvers. In addition to firearms, Sturm Ruger Company also provides various accessories and replacement parts for its products. The company operates in two main segments, firearms and castings. The firearms segment includes the production of lever-action rifles under the Marlin name and trademark. On the other hand, the casting segment involves the manufacture of steel investment castings and metal injection molding (MIM) parts. These castings are sold directly or through manufacturers' representatives to various customers. Sturm Ruger Company sells its firearm products primarily to the commercial sporting market through independent wholesale distributors. The company also exports its firearm products to foreign countries, including law enforcement agencies and governments, either directly or through a network of selected commercial distributors. Overall, Sturm Ruger Company's businesses and services cater to both domestic and international customers in the firearms industry. The Sturm Ruger Co. Inc. RGR stock price has remained relatively stable over the past year, experiencing a mere -2.94% change from March 2025 to March 2026. Several significant news events occurred during this period, but none of them caused the company's stock to drop by more than 4.75%. One notable event was the mixed financial results reported in the fourth quarter and full year 2025 earnings report. Despite missing expectations for diluted earnings per share, revenue exceeded forecasts, leading to a 1.79% increase in the stock price after the announcement. The company's strong revenue and product innovations drove investor optimism. The National Shooting Sports Foundation and several major gun manufacturers petitioned the U.S. Supreme Court to challenge New York's firearm industry responsibility laws on the same day as the earnings report, which saw the RGR stock price increase. Other events such as new gun laws in Colorado, the Supreme Court upholding an ATF rule on ghost guns, and the elimination of a federal tax stamp for suppressors and short-barreled rifles did not cause a significant drop in the stock price. The company's organizational realignment and leadership transition also occurred during this period. Todd Seifert was appointed CEO and president in March 2025, and the company underwent an organizational realignment in June 2025, which included severance and separation-related costs. These internal corporate changes contributed to non-recurring costs affecting 2025 earnings, but did not cause a significant drop in the stock price. Overall, the stability of the RGR stock price over the past year can be attributed to the company's strong revenue growth, investor optimism, and the lack of significant negative events that would have caused a drop exceeding -4.75%. Sturm Ruger Company, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $6 billion. Sturm Ruger Company, Inc. trades at a higher price-to-earnings ratio of 265 times and a lower price-to-book ratio of 2.05 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, an increase in firearms sales, driven by a 7% rise in unit shipments, has contributed to a 2% revenue growth. Additionally, new product sales have seen a significant boost, with $169.5 million generated compared to $159.3 million in the previous year. Furthermore, orders received and ending backlog have also increased by 12% and 15%, respectively. On the other hand, several factors have led to revenue decline. A decrease in demand for company products has been a significant contributor, as well as insufficient insurance coverage to protect against claims or losses. Financial distress among independent distributors and non-compliance with laws and regulations have also had a negative impact on revenue. Moreover, a shift towards lower-margin products has resulted in decreased profitability. The decline in adjusted NICS background checks by 4% has also led to a decrease in firearms sales, resulting in a -23% drop in revenue. These factors highlight the importance of addressing these issues to ensure sustained growth and profitability. The net income and profit margins of the company underwent significant changes between 2024 and 2025. The net income decreased by $43.9 million, $35 million, and $20.4 million, respectively, in different reports. This decline was largely due to a decrease in other income and an increase in the effective tax rate from 19.1% to 38.7%. Additionally, the company faced potential claims/losses exceeding insurance coverage, decreased demand for products, and inventory rationalization write-offs. The profit margins also suffered significantly, decreasing from 5.9% in 2024 to a loss of 2.3% in 2025. This decline was attributed to various factors including a decrease in other income, increased effective tax rate, and a shift towards lower-margin products. Furthermore, the company faced decreased demand for its products, leading to reduced sales and unfavorable deleveraging of fixed costs. The reasons behind these changes are multifaceted and complex. The company's inability to manage potential claims/losses effectively, combined with decreased demand for its products, led to a decline in net income and profit margins. Additionally, the increase in effective tax rate and decrease in other income further exacerbated the situation. Overall, the company's financial performance was severely impacted by these factors, resulting in a significant decline in net income and profit margins. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. One key indicator of this is the positive operating cash flow it has achieved. In 2025, the company reported $54.3 million in cash provided by operating activities, demonstrating that it is generating sufficient funds from its day-to-day business activities. This positive operating cash flow is a crucial aspect of a company's financial health, as it indicates that the business is able to cover its expenses and invest in growth initiatives without relying on external financing. The fact that the company has achieved this milestone suggests that its operations are efficient and profitable, setting it up for continued success in the future. Management statements about the company outlook or strategy suggest a focus on maintaining cash flow stability while investing in growth initiatives. They expect sufficient operational cash flow to meet requirements, with capital expenditures of approximately $30 million allocated for new product introductions and equipment upgrades in 2026. The company is also adopting a cautious approach to inventory management, carrying only what is expected to be needed over the next 3 years. This strategy indicates a commitment to efficiency and minimizing waste. Additionally, management is evaluating the impact of interest rate changes on financial statements, but does not anticipate significant effects from a moderate increase in rates. The acquisition of Anderson in July 2025 is seen as a strategic move to enhance production capabilities, positioning the company for future growth. Overall, management's outlook emphasizes prudence and investment in innovation, with a focus on maintaining stability while driving progress. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out a total of $132.7 million over the period of 2023 to 2025. This includes a special one-time dividend of $5 per share in January 2023. In addition to dividend payments, the company has also engaged in share buybacks, purchasing a total of 1,831,800 887 shares for $72.3 million over the same period. These actions demonstrate the company's commitment to returning value to its shareholders and maintaining a strong financial position. Concerns about inventory buildup and supply chain disruptions are evident throughout the provided summary. On one hand, there is a significant concern about inventory buildup, with multiple mentions of it across various pages. For instance, page 28 highlights inventory rationalization write-offs, while page 50 explicitly states that inventory buildup is indeed a concern. Furthermore, the ending backlog of 12.5 million units on page 33 and the decrease in orders received by 15% from 2023, accompanied by an increase in the ending backlog by 20%, suggests that inventory levels are not being managed effectively. On the other hand, supply chain disruptions pose a significant threat due to limited raw material supplies, which can cause purchase price variations and interrupt manufacturing processes. The dependence on third-party transportation providers also increases the risk of failure to deliver raw materials in a timely manner, leading to increased costs of transportation. Tariffs could lead to increased demand and pricing on domestic materials, potentially increasing costs further. Trade measures and retaliations may disrupt established supply chains, exacerbating the problem. In conclusion, both inventory buildup and supply chain disruptions are pressing concerns that need to be addressed. Effective management of inventory levels and mitigation of supply chain risks are crucial for maintaining a stable and efficient production process. That concludes the financial summary for Sturm Ruger Company Inc. Feel free to comment below, and I will be happy to answer them when possible.